Welcome to the AI for Career Success video overview by Curt Robbins, where we help you get smarter than your competition. Today, we are going to delve into a fascinating paradox that emerged from Alphabet's Q4 2025 earnings report. On one hand, the company delivered a truly record-breaking financial performance. On the other, its stock price faltered. Our goal here is to analyze this conflict between stellar success and the market's very clear anxiety. To understand this complex situation, our analysis is drawn from a synthesis of commentary from leading industry experts and analysts, all published on LinkedIn on February 4th, 2026. This gives us a real-time snapshot of how the market processed this surprising news in the immediate aftermath. So first, let's establish the context here. We need to be clear about the sheer scale of Alphabet's financial success in this period. The numbers were, by any objective measure, exceptional. The headline figure was truly historic. For the very first time, Alphabet's annual revenue crossed the $400 billion mark. Now, this isn't just a milestone, it's a powerful signal of a company that is operating at an absolutely immense global scale. And that growth really accelerated in the fourth quarter. If you look here, year-over-year revenue was up 18%. But what's even more impressive is that net income, the actual profit, jumped by 30%. This shows us it's not just about top-line growth, it's about highly efficient and profitable execution. So what was driving this performance? Well, it was three primary engines. Google Cloud was the clear standout, with a massive 48% year-over-year growth, really cementing its role as a critical driver for the company. At the same time, the core businesses showed incredible strength, with search growing at 17% and the wider digital advertising segment up 13.5%. And of course, we can't overlook YouTube. Its annual revenues have now crossed the $60 billion threshold. That's a huge contribution that just reinforces Alphabet's dominance across multiple distinct market segments. So on paper, the company looks stronger than it has ever been. Now, with all of this incredible success, you'd think the story ends right there, a clear victory. But a single announcement during the earnings call completely changed the narrative, and it explains the market's puzzling reaction. Alphabet announced a truly monumental increase in its planned capital expenditures for 2026. The plan is to nearly double its spending, jumping from about $95 billion in 2025 to a range as high as $185 billion. This isn't just an increase, it's an aggressive, all-in bet on winning the AI race. Just to be clear, capital expenditure, or CapEx, isn't some abstract financial term. We're talking about the fundamental physical infrastructure, the data centers, the servers, the proprietary chips that form the very bedrock of advanced AI development. This is an investment in the core machinery of the future. And this juxtaposition of record earnings on one side and this massive spending plan on the other created the central conflict of the story. Wall Street's deeply divided, and ultimately negative reaction. Logically, you would assume that a company reporting its best year ever, while also investing aggressively in its future, would be rewarded by the market. The stock price should have soared, right? It seems like the only logical outcome. But the reality was the complete opposite. In after-hours trading, right after the announcement, Alphabet's stock actually fell by as much as 7%. And it's this counterintuitive response that we really need to unpack. The reason for that drop really comes down to a deep divide among investors. On one side, you have the bulls, the optimists. They see this spending as a necessary strategic move for long-term AI dominance, and it's being funded from a position of incredible financial strength. But on the other side, you have the bears, the skeptics. They see massive pressure on short-term profits and are worried about the uncertain and immediate return on such a colossal investment. This division between the optimists and the skeptics, it points to a very significant shift in how the market is beginning to evaluate the entire AI industry. It seems we are moving from an era of promise into an era of proof. Analyst Andy Wang captured this new sentiment perfectly in his commentary. He wrote, "The market is no longer rewarding AI promises. It wants proof." That single sentence really gets to the heart of Wall Street's anxiety. What we are witnessing is a maturation of the market. We are moving out of what you could call the era of AI promise, where just announcing a big AI strategy was enough to boost investor confidence. We are now squarely entering the era of AI proof, where the market is demanding to see tangible, profitable results from these massive capital outlays. For professionals, this creates a new and critical lens for evaluation. The key distinction is no longer just about who is investing in AI, The crucial question is now about who is spending on AI versus who is actually earning from AI. And that is the question that is going to separate the leaders from the laggards going forward. And this brings us to our final forward-looking question. The AI arms race, defined by spending, is clearly escalating. But as the market's focus shifts from promise to proof, the real question becomes, which company will be the first to decisively win the AI profit race? Thank you for watching. This is where we teach you AI and help you get smarter than your competition. Please subscribe to the AI for Career Success YouTube channel. We also ask that you like this video, comment with your own thoughts, and share it with your network. It really does help us reach a wider audience.